Alrighty, folks, I am about to learn something. Taylor shared with something offline that I'm like, I don't know that I've heard that. So instead of just him educating me, I thought we should do this together. We will learn at the same time. Taylor from Life Goal Investments, 10-year Wall Street veteran. What the heck is the rule of 20? Because I'm not
Yeah,
sure I know what that is.
yeah. So it's something that's kind of widely known on Wall Street, and it's just a rule of thumb, is what it is. And what you look at is we're getting questions at nauseum right now. I'm getting questions. Hey, where should stocks be trading? Because there's a gap and a range of people saying, hey, we're going down 40% from here, and there's other people saying things are still okay. So like, how do you get a barrier and a range and something that's normalcy as to where they should be trading? And the rule of
Okay.
20 is a really good barometer to say, are we close? Are we far off? So here's how you look at this. So the rule of 20 is based on the price to earnings multiple. The price to earnings multiple is you take the price of a stock and you put it over their earnings. And so you can look at it. It's a good way to compare one stock against the next. It's a good way to compare the entire stock market to what it's historically traded at. So how much is an investor paying for every dollar worth of earnings? So the rule of 20 is as follows. You take 20 and you subtract off inflation. So inflation just printed at 5%. So
Okay.
20 minus 5 says we should be trading at about a 15-time price
Okay.
to earnings multiple. So where are we? We're trading at 18.67 times on the S&P 500 right now. So
Okay.
for context, as you look at the rule of 20 saying we should be at 15, we're trading at almost 19 right now. That measures a 19.66% decrease in order to get to that rule of 20's number that says we should be trading at a 15-time
Hmm.
multiple.
Wow. I had not heard of this, or if I had forgotten it. Yeah, there's a lot of people. I think the S&P, again, if you go back and look at the S&P over the last 2 years, it's essentially flat, right? So
Correct?
again, it's kind of stuck between 4,200 and I don't know 3,850, something like that. And I think we talked about earlier, we're going to validate an earnings recession. And to me, there's always two components. There's the PE ratio, and then there's actual earnings. I think right now Wall Street expects, I think the last number I heard was like 200 or 210 for the S&P 500. Seems richly.
209 was the most recent, so you're right
Oh,
on.
yeah, there you go. It's 209. I I don't know how we get there. I
And that's the thing. So listen, the E on the price to earnings multiple is expected to be at 209. A lot of people are saying, and I'm in this camp, that in your camp, that we probably don't get there. So what happens if the E contracts on the bottom? It forces the price to earnings multiple higher unless
right.
prices contract with it. So a lower earnings multiple or a lower earnings drives a higher PE multiple, gets further away from that 15 times that the rule of 20 says we should be at, unless you get stocks continuing to move downward.
Well, the other thing that's just wild to watch, because again, I'm looking at the stock market for the first time in 20 years. I didn't really do anything for 20 years. I've been very clear about that. But the other thing I watch is the VIX. The VIX is like sleeping. It's like it's snoring. What
So
is going on?
are you familiar with the corollary on the bond side called the move index?
No, I'm not.
So there's one of these two are wrong, and who knows which one is wrong. But the VIX is asleep at 18, 19.
Yeah.
20 is like where you start to pay attention at all. And then again, when things get crazy, the VIX can jump up to 40, 50. That's when things are really scary, like a COVID type reaction. It got above 50. The move index is the exact same thing, but for the bond market.
Hmm.
And what you have right now is an incredibly elevated move index. So you have a VIX, stocks are asleep, they're just trading along. And on the other side, the one that's supposed to be sleepier is acting like we're in this absolutely crazy environment. So which one is right? It'll be kind of TBD, and probably it will be kind of a compression of the two towards each other. But I
Sure.
tend to think if there's one right and one wrong, I think bonds are more right than they are wrong, and stocks are more wrong than they are right. Now, that's just my opinion, but I think the economic data aligns more closely based on some of these rule of 20 type rules of thumb that I mentioned here, along with a slew of other data. But bonds, I think, are reacting more correctly to the actual economic backdrop that we're seeing at this point.
Yeah. And then again, we still have record inflows. I think I didn't see any numbers for last week, but record inflows from retail trading. The buy the dip fans are freaking legit, man.
They
Wow.
are. They move
They're
around
just,
real money.
yeah, it's wild to watch. And again, a lot of these folks do not, we're not trading actively back in the last big recession, or heaven forbid the dot-com recession, which I think is far similar to today, 20 some years ago. And if I'm right, which I'm wrong all the time, they're about to learn a painful lesson, because this will come to an end. The party will end at some point.
Yeah, because you look at the big institutional assets right now and you see them sitting in money markets. So money markets right now have $5.5 trillion
A
of
record
capital sitting
number.
in them.
Record
Record
number.
number. And I only know this because someone asked me and I had to look it up. Pre 2008, it was about $1.2 trillion. And that's
So
so
just a
right. So
little different.
what is that, a 4-time multiple? Right. So when you think back to 2008, how the downside of a crash can be so exacerbated is if there's no dry powder on the sideline to step in and purchase. Right. So I do think that we're in for an economic correction and a recession, an outright confirmed recession by the NBER. But I do think that the depth of the stock market drawdown that we will see will be more muted than it was back in a 2008 scenario. One, because we've already given a lot back to begin with. We already drew down 25% and then we moved back up 10-ish percent. But on the other side, people in these big institutions will start to chomp at the bit. They're not going to start to chomp at the bit when retail buyers get a pullback and buy the dip, buy the effing dip, as they always say.
Yeah.
But on the other side, they will buy the dip, but it won't be until price to earnings multiples compressed more in line with where they should be. And right now, we're just not there based on what I told you here before.
Yeah, it's pretty wild. Again, the buy the dip crowd's legit. And every time I turn around, they've been rewarded. I mean, wasn't Tesla like $100 the other day? Now it's over 200 or 180 or whatever it is. Again, I mean, the longer you stay around, the deeper you get, the margin you go on, it gets paid off. You get conditioned, and then one day it doesn't work.
There's a washout. There's a washout. And what does happen generally in bear markets, as we all know, is the market does gap down too far. And that shakes everybody out. And you get to see, again, who's leveraged and who doesn't have shorts on, as Warren Buffett always says. But like, again, just back to this PE multiple of 20, rule of 20, the one thing I wanted to say, just to kind of bring this home and try to make it make sense to everybody, is you take 20 and you subtract off inflation. Why do you subtract off inflation? Warren Buffett's got the greatest line on this, is inflation is like gravity to stocks, because it creates higher interest rates. It creates their debt financing to become more expensive, and it creates a higher hurdle for them to jump over to become profitable. If their debt goes from 2% to 5% or 6%, all of a sudden their revenues have to jump a lot more meaningfully in order to create that profit. And that is that gravity that causes that rule of 20 to make sense.
Taylor, you put out a lot of stuff. You educate folks. You educate me all the time. Where can people follow you to get these kind of little tidbits and get better at it?
Yeah. Thanks so much. Appreciate the kind words. Follow us on Instagram and on TikTok at Life Goal Investments. We do a little different stuff on both of them. So appreciate it though, Michael. Thank you.
And stay tuned for the weekly rants. I love it when he goes off and he just loses his
Once a week, I just kind of lose my mind because something just fires me up.
those are fun. Thanks, buddy.